From London, I'm Guy Johnson with Bonnie Quinn over in New York. This, of course, is Bloomberg Markets. A lot of data out earlier on. Markets generally seem to be largely ignoring it. Let's get a check on what is happening. Abigail Doolittle, over to you.
Guy, it's certainly an interesting market day at this point because we're looking at mixed moves for the major averages, at least here in the U.S. If we take a look at the Dow, we are going to see that index is sharply lower, while the S&P 500 down a little bit less, the Dow down about 1%. You can see the S&P 500 down about 0.4%. The NASDAQ, however, outperforming, well off of its highs, at the highs up more than 1%, but up 0.3%. And then the Dow Transport's down a lot, down 2.1%. So we have very jittery trade. This is investors continue to digest the jobless claims data that we've had over the last 3 weeks, the enormity of that number, the economic data yesterday. It feels like it could be perhaps an inflection point. However, the engine that has been keeping this rebound rally going recently, the FANG stocks, and especially Amazon. Take a look at Amazon this week, up 16%, really incredible, hitting another all-time high, the best 4 days for Amazon going all the way back to 2015. There's an interesting nuance within to make of Amazon with it climbing, because of course investors assuming the company will do very well with the global lockdown, or most of the globe being under lockdown. On the other hand, if that's the case, it may suggest that the economy could have a longer time getting restarted. But keep an eye on those FANGs, because if they do start to lose steam, it could be a problem for the markets. And then finally, Morgan Stanley, of course, our Eric Schatzker was talking to James Gorman, the CEO, and that stock has been down, not just today, but recently on those results. And you can see there over the last 4 days this week, down 9.2%. Big trading, but it's not clear whether or not that will last. Bonnie, back to you.
All right, Abigail Doolittle, thank you for that. The grim economic data continuing to really flood in now. Jobless claims hitting 5.2 million last week. The Philly Fed index nosediving, and housing starts also plunging. Let's bring in Bloomberg's international economics and policy correspondent Michael McKee, and we'll begin with what James Gorman of Morgan Stanley just said, Michael, and that is that a circumstance that no one could have predicted and no one would have wished for has forced firms to take decisions that they wouldn't otherwise have, but that have really become success stories. So, for example, Morgan Stanley realizes now it doesn't need all the real estate it has.
Yeah, I thought that was a fascinating comment, Bonnie, and it points to the discussions that are going to come out of this, and that is, how do we redesign the economy for new realities? Not just the fact that maybe we don't want to all sit right next to each other in cubicles anymore, but do we need to, and would people be more productive having some time at home? It's going to be something that everybody's going to be looking to. But Mr. Gorman also noted the chart there that we have had an enormous number of jobless claims right now. Another 5,245,000. That makes 22 million 34,000 in the last 4 weeks, and that almost completely wipes out all of the job gains of the last 10 years. And that's the thing he was looking to first in terms of restarting the economy. He said, you've got to get the health problem solved. Nothing happens until you get that solved. And once that's solved, it's going to be a very slow ramp up. And he won't see the economy getting back to anything close to what it was like until all those people who lost their jobs have been absorbed back into the labor force.
Mike, can I just stay with the real estate theme? The housing data today was weak, but you can kind of understand why. A lot of sites have been shut down. A lot of people can't move house right now, as a result of which you're going to see some weak data. The housing market is a key part of the kind of Fed transmission mechanism, so presumably the Fed's going to be keeping an eye on this. But I'm also kind of aware of the fact that America is net short of housing right now. And once we see a bounce back, once people start to get back into the labour market, we're going to see those sites reopen, and the housing data is going to sort of bounce back quite strongly. Am I reading that correctly?
I think you are. I was talking with a builder today, Guy, who said that, the idea that housing is going to remain depressed is probably not true, because while you may be reluctant to go to the movies, or you may be reluctant to go to a restaurant where you're all crowded in, you may have been saving for some time to buy a house, or you may be in the process of buying a house and it's simply been interrupted. Because it's a big one-time purchase, you'll probably go ahead with that. It's just going to be put off, shifted later into time. And with interest rates as low as they are, and they're going to stay this way for a very long time, you're not going to get anything cheaper, so you might as well continue with that. Now, this isn't the normal kind of stimulus the Fed looks to when it lowers interest rates to get out of a recession, but hopefully it helps. Hopefully if people do move, if real estate picks up quickly, people buy furniture and other furnishings for the house, and we do see that add into the economy.
Of course, the Philly Fed Index took a nosedive as well. Michael, we'll be looking to the ISMs. It's just going to be very depressing. At what point is it all priced into the market?
Well, that's a good question. I think you noted today that we haven't seen a major reaction in the markets. We saw one yesterday when we got the bad retail sales numbers, which was a little bit of a surprise because you'd think it would all be priced in. But on the other hand, we do have the president holding out the possibility of a news conference today to announce his plans for reopening the economy. He doesn't get to do it, but is somebody talking about it like that? Maybe giving the market some hope that these numbers are temporary. And Gorman noted that this was as fast a stop as we had ever seen, as deep a plunge as we've seen since the Great Depression. But it happened so quickly that hopefully we get out of this period of medical-induced coma very quickly. It'd be a slow recovery, but we stop losing ground much more quickly than we do during a normal recession.
We know that one side of it's a V. We just simply don't know what the other side of it is. Mike McKee, as ever, thank you very much indeed. Bloomberg's Mike McKee on the economy. We're going to carry on the conversation when it comes to what is happening with the big banks. It is a big week for the big banks, particularly in the United States. We're going to dig into the numbers with Devin Ryan, JPM Securities Senior Analyst. That conversation coming up. This is Bloomberg.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with LACWA.
economic impact, the GDP decline is obviously much worse, but it's so specific and it's built around the virus. You know, what kind of world will we have when we have immunity from it, when we have, you know, the right testing? There are so many unknowns now, whereas back in 08, it was a fundamental collapse of the whole financial system. And had it not been, you know, the system not been rescued, then who knows what long-term damage, multi-decade, might have been to the economies.
Morgan Stanley CEO James Gorman discussing the impacts of the virus pandemic on first quarter earnings. Let's get some more details on what is happening not only with his bank but also other banks as well. Joining us now with some analysis, Devin Ryan, JPM Securities Senior Analyst. He has a market outperform rating both for Morgan Stanley and for Goldman Sachs. Devin, look, the U.S. banks are holding up right now. My question is, how sustainable is that?
Hey guys, thanks for having me on. So I think there's a couple things going on here. You have the first quarter, kind of extreme backdrop in asset prices. Kind of this gross deleveraging that happened, both institutional balance sheets but also retail balance sheets, and so that I think contributed to kind of the extreme move in asset prices, and so that negatively affected results quite a bit in the first quarter. But on the other side of that, you saw great trading activity from all the banks, and I think that shows kind of some of the natural hedge in the business model. And this is very different today than what we would have seen 10 years ago, when firms were leveraged substantially more, had riskier assets on the balance sheet, didn't have the capital cushions that they have today. So I think the banking system is actually performing quite well. The quarter was extreme. There's going to be some lingering kind of negative effects. The equity markets are still down 20%. Interest rates are low, and we think will remain low. And so that creates a headwind on the other side. You may not have the same degree of mark-to-market issues going forward as you saw in the first quarter, and that was really one of the things that drove results as low as they were in the quarter. But all things considered, I think the banks actually did pretty well. Both Goldman yesterday, Morgan Stanley today, and all the other large banks have reported.
We're just seeing a headline saying the small business loan program now out of money, which is certainly something that DC needs to get round to fixing pretty quickly. What do we know about, sort of in aggregate, what credit losses are now going to look like? Do you think they're being conservative still? Do you think some of those credit numbers are going to have to go higher?
Yeah, so credit numbers are going to go higher, without a doubt. You have both the COVID, but you have what's happening in the energy complex as well, which you have a number of kind of highly levered companies that I think are risks in terms of from a credit perspective. Firms did provision quite heavily in the quarter, and that was both to reflect the economic backdrop, but also there were some accounting changes as well that affected the provisions. We'll probably have more kind of elevated provisions on a go-forward basis, and that's something that companies are talking about. And really, you have to dive into the scenarios that companies are all applying. Some of it's a bit subjective, but they're also going kind of loan by loan. And so, yes, there will be higher provisions. The good news is these banks, especially the large banks, have phenomenal capital positions. So, they're going to weather that quite well. I think there's bigger kind of economic questions around, how long it takes to pull out of this, and to what degree do we get a recovery. There should be some recovery, but are we getting back to where we came from? Maybe not. And so that could lead to a little bit of just more elevated credit than we've seen for some period of time. But again, I want to take a step back. I mean, if you look at the banking system today versus a decade ago, just such a different position, and the natural hedges in the model that you're seeing right now, just around businesses like trading, or when you get a flight to safety, investor is essentially your clients move more money to cash, and so you saw huge increases in deposit balances during the quarter, and so that provides a little bit of mitigation to some of the net interest income issues and some of the credit issues that will likely continue to come here.
I just want to reiterate that we learned a few moments ago that the small business loan program has run out of funds. Congress obviously has stalled. The president does want to add another $250 billion to the initial $349 million. And we knew yesterday that way over 1 million applications had been approved since the beginning of the program, which was April 3rd. But obviously a lot more need to be approved, and a lot more are looking for funding. Devon, what can banks do to help the economy to get back on track? I mean, there's so many Fed programs out. There's this SBA program that benefits banks too, honestly. I mean, Mnuchin came out and said, look, we're upping the interest rate to 1% from 50 basis points. Get your, tellers on the computers, get these applications processed. It's in everybody's interest to do this. Are the banks working as hard as they can?
Hey, Bonnie. So I think they are. I mean, if you look at all the steps they're taking, both in terms of kind of normal business to support their clients, I think it's been pretty tremendous over the last month and a half. And, the government as well is taking unprecedented steps to try to kind of lessen the blow and step in. And so there's been a pretty coordinated effort between government, the Fed, and the banks to really try to step in and support clients, under the programs where they can. And the business lending is one example. I think there's a number of other examples. If you look at just through earnings, each company's kind of been detailing what they're doing for both customers but also the communities with kind of this health pandemic. And there's been a number of steps. There's huge charitable giving, and I think that they're really trying to put themselves in the best position here, to really help customers and their communities, in this really challenging time. And I think you're seeing that across the organizations, both in what you saw in the first quarter, but I think there's a lot more to come in the coming quarters as well.
So, Devon, I know
and to your point, it really is in their best interest as well. So, there's a number of motivations here, but I think it's in the company's best interest to get the economy back on a solid footing here, and have their customers today, new customers, able to repay loans and have a reasonable paycheck coming in.
I know you were listening to James Gorman on Bloomberg Television just a few moments ago. Did you get the feeling that he might be trying to renegotiate some leases, Devon? He made the point that, absolutely, the bank can really almost 100% work without real estate at this point.
Yeah, it's an interesting question because I think that this working from home, essentially being forced into that position has been so much smoother than probably any company across the economy was thinking just how abrupt it was, and banks are no exception. And I think that for a number of these companies, there's going to be questions around real estate footprints and staffing, travel budgets and entertainment, and so there may be room to change the frameworks a bit, and that could lead to some expense savings. But just how people are doing business and how smooth it has been in this kind of virtual world, I think could have a number of lasting impacts. It's a little bit early. I think companies are more focused on serving their clients today and making sure that employees are healthy and able to function kind of remotely. But I think there will be a lot of deep thought coming out of this around opportunities for the banking system to maybe be more efficient and kind of leverage their technology even more.
All right, we have to leave it there. But Devon, thank you so much for your time today. That is Devon Ryan, JMP Securities Senior Analyst. Coming up next hour, we're going to continue the conversation about the global economic outlook and get the prescriptions from Kristalina Georgieva. She is the IMF Managing Director. That's coming up at 11. This is Bloomberg.
This is Bloomberg Markets. I'm Guy Johnson. In the next hour, we are going to be speaking to the Airbus CEO, Guillaume Faury, in an exclusive interview. This is Bloomberg.
Live from New York, I'm Bonnie Quinn along with Guy Johnson in London. This is Bloomberg Markets. Time now for our stock of the hour. Here's Dave Wilson.
I'm here to talk about Bank of New York Mellon. Now, this is what you would call a trust bank or a custody bank. So really it's all about safekeeping of securities, processing trades, that sort of thing. 3/4 of their revenue comes from what they call investment services. And analysts are expecting revenue to be down in the first quarter as well as earnings. Well, Bank of New York Mellon delivered positive surprises on both fronts. Profit beating projections and sales coming out ahead as well. I mean, what benefited Bank of New York Mellon was just all of the volatility in markets last month and all the trading that went along with that. You know, they talked about, among other things on their conference call, about how, U.S. trade volume was up 50% last month from the pace in January and February. And then the amount of global settlement of trades they did was up 40% in that same period. So you put that all together, and they had a 10% increase in fee revenue for the quarter, and that benefited them at a time when the net interest revenue was falling because interest rates were down. And as opposed to other banks that have had to set aside billions of dollars for potential loan losses down the road, they only had to make a loan loss provision of $169 million. So, they're clearly in a much better position than, the biggest U.S. banks when it comes to being able to deal with what's ahead as a result of the coronavirus. Now, they did talk about how actually the assets that they have either under custody or administration, I mean, that's really the trust bank side, rose 2% in the quarter. While their investment management side, their other main business assets were down 2%. A lot of that tied into losses coming out of the stock market. So, you put it all together, and it's a set of results that people weren't anticipating, and you've seen the shares take off as a result of that. Bank of New York Mellon's been up as much as 9% in today's trading, one of the day's top performers in the S&P 500.
Yep, and it's interesting when so many other banks are trading lower today. Dave, thanks very much indeed. Dave Wilson with our stock of the hour. Now, the German government has unveiled a €30 billion backstop at commercial credit insurers to keep trade flowing and prevent bankruptcies. The CEO of Europe's largest insurer, Allianz, told Bloomberg he welcomed the measure, but the industry is still set for massive losses.
The coronavirus has hit our industry like a meteoroid impact. And so it's this really systemic effect on the economy. And for the credit insurance side, we're the world market leader. The business model normally would suggest that we cut our credit lines that are massive, Germany, 400 billion for the industry alone, down, and would actually create a domino effect that may lead to increase in insolvency. So the government has clearly learned from the 2008 and 2009 crises and has worked with the industry and us as a leader in the industry to set up a program that prohibits these procyclical behaviors from occurring. And it's a very, very important measure the government has taken. I can only congratulate them because it will help us to stabilize particularly small and medium-sized companies in trade in Germany and beyond Germany.
Oliver, Matt Miller here in also sunny Berlin. Wouldn't you be able to do that even without this? I mean, don't you have the resources, or is the scale of defaults so big that Allianz needs the government to step in and backstop losses?
No, absolutely we don't need that. It's very important to understand that the way the credit industry works and credit insurance industry works is allowing us to manage risk the way we really want that, particularly Allianz. We are extremely stable. We could absorb all the losses. The problem is the following. As you have seen in the capital markets over the last few weeks, is that people will then behave in a very procyclical way. So, for example, if we cut exposure lines, we're insuring trade credits, then people will further reduce trade, and that may lead to insolvencies that we would not cover. So the economic effects would be highly detrimental, but Allianz would be saved. And that's unfortunately an outcome of the industry business model. And we've had learnings from the 2008 and 9 crisis, and told the government, if you don't want this domino effect, there needs to be a public-private partnership to make this thing happen. In fact, it's not a protection of our balance sheet because we don't need the protection. What we are doing is we're extending lines of credit that we would normally not hold.
Okay, so this makes sure that any decisions that are made around trade financing then don't make things worse than they already are. Oliver, do you need, or does the insurance sector need support that goes further than this? Is there an area of the insurance industry, or perhaps another geography, where you would like to see something similar to what's happening in Germany?
I personally believe that we would actually need a solution like this on the European level. The French government has also enacted something, but it's much more limited. And there are areas, and we'll talk about it once we are through with the corona short-term impact, because this is such a massive earthquake-like, and again, I would like to compare that to a meteoroid impact, that there are certain covers, like terrorisms that we do have today in Germany and in other countries, or nuclear power plant blowing up, that cannot be insured with normal policy wording, where you need an industry solution, a public-private partnership. And I think going forward, we need to look across a number of sectors and exposures and say, how can we make sure we cover better the needs of society when you have a systematic effect? Please remember, systemic risk is not something that the insurance industry can insure. We rely on diversification over time and in the portfolio. Just imagine that we would not have 1 in every 10 cars having an accident every year, but everybody having an accident. Then motor insurance would become unaffordable. So we need diversification, and corona or any large pandemic is a systemic event that does not have diversification. So the industry economic model cannot really work. To your question, we do not have, as a company, large exposures, and I don't know about any others, if the contracts and the contract laws are upheld. Now, losses for the industry, in my opinion, personal opinion, are going to be massive. There's a lot of debate, are insurers really putting up? I can tell you across sectors, whether that's healthcare, business interruption, travel, media and entertainment coverages, there will be huge losses for the industry coming. It just takes a while for those to materialize. So 2020 is not going to be a record earnings year for the insurance.
And that was Oliver Bäte, CEO of Allianz. Let's take a quick check now on the latest headlines surrounding the coronavirus. For that, we'll get to Viviana Hurtado.
Bonnie, the IMF calling it the Great Lockdown, global recession, and we are seeing more fallout of the coronavirus freezing the economy. Here in the U.S. last week, about 5.25 million Americans filing jobless claims. The total, 22 million jobs vanishing in the month of the lockdown. And around the world, leaders, well, they're really balancing a gradual reopening of their economies with containment of the spread of COVID-19. Over in the UK, officials, well, they saw signs it may be past the worst. This as total coronavirus cases cross the 100,000 mark, and it is expected to extend its lockdown over to Germany and Spain. New cases in those countries climbing. Spain, in fact, planning to keep most of the restrictive measures in place. Over in Asia, well, there are pockets of new waves of infections. In Japan, Prime Minister Shinzo Abe declaring a nationwide state of emergency. That's because the infection there is spreading, and Singapore reported its highest daily increase in cases. And so to fully and safely get people back to work, business leaders are saying widespread testing is necessary. To that end, Amazon chief Jeff Bezos telling shareholders in a letter it's developing COVID-19 testing, the first step toward regular checks on its employees worldwide. And U.S. President Donald Trump says he will unveil guidelines to relax stay-at-home rules on Thursday. He is pointing to signs the outbreak is plateauing in parts of the country. Guy.
Thank you very much indeed, Viviana. Right, still ahead, market reactions to the economic data that we've seen out of the United States. None of it's good. It is showing the brutal impact of the coronavirus pandemic. That's next. This is Bloomberg. From London, I'm Guy Johnson with Vonnie Quinn over in New York. This is Bloomberg Markets. So another round of disappointing data being delivered out of the United States today. Let's get a sense of what that means for the rates market, what that means for the US curve, and ultimately what that means for US equities as well. Let's welcome Bill Baruch of Bloomline Futures into the conversation. Bill, more disappointing data, but I guess we probably anticipated much of it. The market reaction broadly kind of neutral. Nevertheless, the US curve over the last few days has continued to flatten up. The message coming from the rates market is actually things are not okay. Yet equity markets aren't saying that. What is your read, A, of the data, and B, of how that's being priced into different markets?
Well, there's two things here that have stood out the most to me. First, when you had the rip higher in equity markets last week, treasuries were very, they moved lower, but very shallow. You're looking at the 30-year bond. It was very shallow, push lower, and ultimately that's set up for the next leg higher that's developing right now in the 30-year bond, which is going to flatten the curve. I like treasuries. I like the 30. I'm long the 10s and the 30 for a number of strategies that we use. But additionally, you look at the market broadly, it's only a handful of stocks really pushing equities higher. It's Amazon, Netflix, got some healthcare that's doing it. Amazon, I mean, is just amazing seeing what that stock has been able to do. But the entire market, the S&P 500, will not be able to track just Amazon. So I think the treasuries are giving us a signal that there's some weakness to come here in the equity markets. Yep. And I would like the 30-year to leg up one more time.
Aside from the 30-year, where do you see the best risk-reward right now?
In the Treasury curve, where I see the best risk-reward, this morning our trade list program,
more
which is
broadly,
not
just in the Treasury curve, more broadly across assets.
Well, I actually like the Treasury curve. I like being long the 30, and our program that's up 13.9% this year actually got long the 10-year today through an option strategy. I think there is some upside here in the immediate term, as well as the intermediate term, and in the 10s and the 30s. Additionally, if you've been long equities, there are places to reduce some risk. I think it's smart to reduce some risk in equities at these elevated levels. And then on top of that, crude oil is also on my radar. We're seeing that crude oil curve flatten out a bit. The May contract, which is going off the board, you have options expiration today in May. The $20 strike has 11,000 open interest. That's keeping a floor in the May contract. This is what I've been looking for is June to close that spread. June is weaker. It's down about 50 cents, where May's up 40 cents. I'm looking for a target to the downside in June, about 23.5 in the June crude oil contract.
It's fascinating. OPEC saying that it sees demand for its crude dropping to the lowest level in 30 years. On that note, Bill, we'll leave it. Thanks very much indeed for your time. Greatly appreciate it. Bill Baruch of Blue Line Futures. Bonnie.
Well, we have a great hour coming up, Guy. We are counting down to the European close, of course. I'll be speaking with the Managing Director of the IMF, Kristalina Georgieva. This as the IMF World Bank spring meetings take place in Washington, D.C., but of course they are remote these days. And then you'll be speaking with the Airbus CEO, Guillaume Faury. That's coming up just after the close at 11:30 Eastern. So do stay tuned for the next hour. We're going to get a very, very broad look at what's going on in the global economy, from the agency and institutional side to the company side. This is Bloomberg.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
From London, I'm Guy Johnson with Bonnie Quinn, of course, over in New York. We're now counting you down. European close here on Bloomberg Markets. Bonnie, European markets kind of mid-range, gapped higher first thing this morning on equities. We've since been in actually a very tight range relative to the recent swings that we've been seeing. We're up around 0.6%. That's tiny compared with some of the huge swings. We are seeing a tightening of the BTP Bund spread today. That's worth paying attention to. So Bund's on offer. We're catching a bit when it comes to the Italian bond market. The euro is on offer as well. The dollar is catching a bit today. Crude is a little lower. We're down by around 0.8%. OPEC warning of dramatic demand destruction. Bonnie?
Yeah, let's take a look at where we are now in the US, because it was a very mixed market earlier on. We seem to have at least changed our tune when it comes to the S&P 500 is now up 0.3%, joining the Nasdaq, but the Nasdaq is up 1.25%. It's only the Dow Jones Industrial Average right now that is lower today. We had a raft of earnings and a huge amount of economic data, very poor economic data. So, for example, in the S&P 500, it is some of the banks still dragging it lower, but the Dow's worst performer right now is Boeing, which is down 5%. ExxonMobil, of course, in there as well, and then JP Morgan Chase. Let's have a look at where Morgan Stanley is trading. We had earnings from that bank this morning. It's been a little bit all over the place, but down 1% now off its lows. As you can see, the 10-year yield is at 60 basis points after we got another whopping claims number, which we were expecting, but nevertheless is a shock to the system when you see it actually come out. Crude oil back above $20 a barrel, just up about 33 cents. Don't forget, the U.S. government said yesterday it was mulling paying drillers to keep oil in the ground. We're going to have oil mountains here in the U.S. pretty soon. And the VIX index just above 41.
A lot of oil. Okay, let's check in with the Bloomberg First Word News. Bonnie, here with the details. Really good job.
Thanks, Guy. The coronavirus outbreak has now effectively erased a decade of job creation. More than 5... 17%. President Trump will unveil plans to relax stay-at-home guidelines today. He's suggesting that the coronavirus epidemic is plateauing in parts of the country. The president spoke with more than 200 business leaders yesterday. Finance executives told him that more testing needs to be in place before people feel comfortable coming to work. In Japan, Prime Minister Shinzo Abe has announced a nationwide state of emergency. It's aimed at stopping cross-border movement of people and increased social distancing. Abe says it will stay in effect until May the 6th. Japan has had more than 9,000 virus cases and about 150 deaths. And OPEC sees demand for its oil falling to the lowest in 3 decades. The cartel's latest report says less than 20 million barrels a day will be needed from its members in the second quarter. Even if OPEC members fully implement those new cutbacks, they'll be producing more than the market needs. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Vani Guy.
Ritika, thank you very much indeed. So Morgan Stanley's best trading performance in more than a decade capped off a quarter in which Wall Street capitalized on wild market swings. But the firm also cast doubts on whether those gains can continue. Bloomberg's Eric Schatzker talked with Morgan Stanley's CEO, James Gorman. He started by asking Gorman about his recovery from the coronavirus.
I'm doing great, thank you. I'm completely recovered, and, to be perfectly clear, I had the virus, but I was one of the lucky ones. I was not hospitalized. My lungs did not get infected, which is, was a real blessing. And, while it's unpleasant, it's certainly, in those conditions, it's manageable. My heart just goes out to the folks who were not that fortunate or who had underlying health issues and the very elderly who, have really struggled and tragically passed away. I mean, it's a curse, and I just wish everybody well who gets it, and wish them stay hydrated, stay rested, and wish them the best.
I second those wishes. James, Ray Dalio told me yesterday that this is much worse than the 2008 financial crisis. What kinds of base case assumptions are you making at this point for the recession and the recovery?
I'm trying to think. I'm not sure I agree with that. I mean, the economic impact, the GDP decline is obviously much worse, but it's so specific, and it's built around the virus. What kind of world will we have when we have immunity from it, when we have, the right testing? There are so many unknowns now, whereas back in 2008, it was a fundamental collapse of the whole financial system, and had it not been, the system not been rescued, then who knows what long-term damage, multi-decade might have been to the economy. So, but listen, these were both truly tragic situations. I mean, from our perspective, in running a company, there's, a few things you got to focus on. Number one, we've got millions of clients trading trillions of dollars all over the world. Our plant has to work. We have to be able to facilitate clients doing that so they can manage their businesses. They have to have the ability to manage their own liquidity and funding and capital needs. And we play a critical role in that in the number one equities player in the world, one of the largest wealth managers in the world, one of the largest capital markets businesses, etc. So number one, the plant has to work. And thank God, Eric, with 90% of our employees at home, we've had almost no issues from our plant. And that's just a remarkable testament to the tech and ops teams at this place. The second thing is you do your bit. I mean, we voluntarily cut back on our buyback to zero. We thought it was best to preserve our capital to support clients in need. We're obviously doing everything through our communities that organizations like ours that are large and have resources should be doing. Third thing is to make sure that our teams are properly coordinated given the remote isolation everybody's going through. And we spend an enormous amount of time communicating with them, setting up plans. What would it be like to bring people back to work? Starting to think about what the future might look like.
It's clearly not as bad, or at least you don't think it's going to be as bad for Morgan Stanley, and perhaps not as bad for the banking industry as the 2008 financial crisis was. What about the broader economy? 5 million people filed for first-time unemployment benefits last week. It's 22 million, in excess of 22 million since this began. how do you fathom or even model the kinds of dislocation unemployment on that scale is going to produce there?
Yeah, what the shock to the global economic system is something we haven't seen since the Great Depression. And as you point out, is far more dramatic than what occurred during the financial crisis. And in addition, we have this massive health crisis, which is working its way around the world with at times devastating consequences. You can't model this. I mean, what you've got to do is preserve your capital, make sure you're well positioned to deal with the risk, understand the risks you're taking on as a business, and manage your way through that in a way where the whole team, as I said, is working together. We have, daily operating committee calls, we have risk committee calls constantly. The whole team is organized around how do we ensure that A, we're doing our job for our clients, and B, that Morgan Stanley remains stable during a period of incredible dislocation.
Morgan Stanley CEO James Gorman earlier on Bloomberg TV. Now, spend as much as you can, but keep the receipts. That's the message from the International Monetary Fund today, as it reinforces the point that this crisis is like no other. The IMF is forecasting a global GDP contraction of 3% this year, a plunge in global trade volume of 11%. So far, more than 100 countries have asked for assistance. IMF and World Bank are implementing a debt moratorium for these countries that they help until at least the end of the year. IMF Managing Director Kristalina Georgieva joins me now from the virtual spring meetings in Washington, D.C. So, Ms. Managing Director, let me ask you about the SDRs. You've just said that you are looking into trying to use them, what you have already, for developing countries. At the same time, you have called on the G20 to support the creation of more special drawing rights. The Trump administration is not on board. Can you change the White House's mind?
What I want to start from is that where everybody is on board is for strong, decisive action now. We do have $1 trillion lending capacity, and we got the full endorsement of our IMFC. This is the governing body of the IMF. They're telling us, lean forward with what you have. And we are doing exactly that. We are doubling our emergency financing. We are taking very decisive actions on expanding what we have, like the creation of short-term liquidity lines. And in addition to that, we are mobilizing concessional financing for our low-income members. And what impressed me tremendously today is that we are making a call for $17 billion to increase concessional financing. I made this call yesterday. Today we got 70% of this funding secured. Now, when it comes to SDRs, the consensus is not there. But where we heard from the membership an encouragement, again, in the spirit of do what you can now, is to look more closely into existing SDRs. Advanced economies have them, don't need them. Developing countries need them, and the question is how to create a bridge so we can move resources, more liquidity support to emerging markets. And as we step up our work, we need to recognize that the problem is gigantic. The resources we have to deploy are significant, and we need to move with what we have very, very rapidly.
So far, at least by the end of April, you will have helped 50 countries, but more than 100 have asked for assistance. And there is a hierarchy, Kristalina. What do you need from private creditors, for example, in order to do more for those countries you haven't yet been able to help?
What we achieved during this week is quite incredible. We got official bilateral creditors to agree on a standstill in the context of G20. So we have the Paris Club, but also the Gulf countries, China, India, all coming together to provide breathing space to our poorest members. And in that call, we also turn to the private creditors, and we are asking them to step up and in the terms of the official bilateral creditors to also ease the debt burden on low-income countries. Now, we need to recognize that this is a highly uncertain environment. We need to carefully watch how the crisis evolves. Our projections are dire as they are, but epidemiologists are telling us it may get even worse. And therefore, as we look into this picture, we have to bring everybody on board. We need to make sure that we all are in this together, because liquidity problem turning into solvency problem is a much bigger problem. We have to prevent that from happening.
And remittances, Kristalina, are becoming a huge problem as well. And I know that the amount of remittances also plays a role in your hierarchy of assistance. But the trouble with remittances is that they're putting pressure on currencies, and EM currencies are weakening. In that context, do you anticipate any Asian countries looking for help from the IMF and World Bank?
Well, at this point, what we are seeing is Asia is staying flat. In other words, we are not projecting negative growth for Asia as we do for the world as a whole. We do have in Asia some countries that have built since the global financial crisis strong buffers, and that helps them now in this more difficult time. But of course, we are there for the membership, and actually creating the short-term liquidity line is something that we believe is very helpful for strong countries. They may experience short-term liquidity pressure, and then we can help with that. In terms of the requests that are coming to the fund, I can tell you that they are many low-income countries, but there are also some middle-income countries that are saying we want to get that additional cushion, or they're seeing the dramatic developments because of their economies being more dependent on hard-hit sectors, be it tourism, or because of the point you made in the beginning, remittances shrinking or even drying up. We're there for the whole membership. And let me make one very important point. This is not a crisis caused by bad governance. It is a crisis caused by pandemic.
Yes.
And in that sense, there is no stigma coming to the IMF, and the emergency assistance is not with strings attached and conditionalities. The only thing we are asking is spend money for your doctors and nurses and to protect vulnerable people and sectors in the economy.
Speaking of middle-income countries, do you think Europe should consider seriously a joint bond issuance, debt mutualization? When will the IMF have a position on that, Kristalina?
Well, the view of the IMF is threefold. One, we strongly endorse the steps that have been taken in Europe by individual European countries, but also by the European Central Bank and the European institutions. They're large, appropriately so, and they are done with good targeting as well as with temporary nature of some of these measures. Secondly, Europe already has some mutualization through the European stability mechanism and also through the European budget,
but Corona bonds are a hot topic.
And three, let me get to that. And three, the European countries are actually debating how they can provide more precautionary saving, more of a buffer against this crisis. And as you know, the debate is ongoing in Europe. Everybody who knows Europe knows that sometimes it takes a while for countries to come together. My conviction is that Europe will stand together in the face of this crisis.
Okay, well, that's a positive outcome, I guess. Talk to us about Argentina, because we are expecting the offer will be made to foreign creditors today for $69 billion. Have you spoken with the finance minister, Mr. Guzman, at all about this, Kristalina?
My team is in close communication with Minister Guzman. I haven't spoken personally to him recently, but I have been in communication with him and the President of Argentina multiple times. What I can say is that our assessment is that first, Argentina has taken strong measures in the face of COVID-19, despite of the difficulties the country has. Second, that they are acting in good faith. They're going to put an offer because they do not want to default. They want to find a pathway to an agreement with their creditors. And third, that we need to also all recognize the world has changed, and countries that were with difficulties before are having even more difficulties now. I do wish well to Argentina, and I do hope that there would be a constructive engagement. Of course, it is for Argentina to negotiate with the creditors, but it would be good for Argentina and for everybody in this incredibly uncertain environment if we have some good news coming.
Kristalina, what, if you could wave a magic wand, what would be the thing that you would wish for in terms of the SDRs right now? Do you need to expand the amount of money that you have at your disposal? And if so, who can you count on for that?
Well, let me say that I have full confidence that for the next months, when we are striving to stabilize the emerging market developing economies that are hit by this crisis, we do have financial strength that is sufficient to do our job. Let me remind everybody that before the global financial crisis, the IMF had $250 billion lending capacity. Now we have 4 times more. I'm also convinced that the membership would come through should the conditions are more adverse. And we have seen that we can find solutions to common problems effectively. We did it in the past. We had done some of it today, raising concessional financing. If the needs are there, we would do it again.
Kristalina, thank you so much for all of your time today, coming to us from the virtual IMF World Bank Spring Meetings 2020. That is the IMF Managing Director, Kristalina Georgieva. Still ahead, our exclusive interview with Airbus CEO Guillaume Faury, who says the company is facing the gravest crisis in its history because of the coronavirus pandemic. That's coming up on the half hour with Guy Johnson. This is Bloomberg.
From London, I'm Guy Johnson with Bonnie Quinn over in New York. This is the European close on Bloomberg Markets. Let's figure out what's happening with those markets. Here with the details, Abigail Doolittle.
Guy, we're looking at slightly different markets than we had just an hour ago. Still jittery, or an hour ago mixed to the upside and the downside, but now the bulls are really trying to take it. We do have gains mainly here in the U.S. Take a look at the S&P 500, now up 0.6%. An hour ago, it had been down 0.6%. Stocks in Europe also doing relatively well. Take a look at the Stock 600, up 0.8%. The FTSE 100, up 0.7%. So investors continuing to digest the dismal economic data that we have had of late as the new reality. Right now, again, the bulls are taking it. Now, where we have some bearish action is the euro. Take a look at the euro against the dollar on the week, down about 1%. Now, this is not the most bullish picture, however, only because the weakness primarily has to do with dollar strength and investors going into the dollar on the dismal economic data. So something to pay attention to if that euro continues to decline. Again, not really a risk-on signal. Now, flat on the day for the most part. Take a look at the commodity complex. Actually, the bulls are trying to take it here, too. We have New York crude, WTI, up 1%, earlier about flat. Brent crude down about 1%. That continuing divergence or split there. Copper and gold also higher on the year. Much different picture. Commodities down in a huge way. To give you an idea, we have oil down more than 60% on the year. Gold a bright spot, though, on the year, up more than 10%. And then finally, of course, one of the big stories this week beyond the economic data, the earnings reports to come out of the banks. And across the board, really dismal reports. Profits plunging, big loan loss reserves. A bright spot is trading, but Morgan Stanley today even said that they're not sure that trading strength can last. So the new reality of this economic data and earnings starting to hit investors. But right now, small gains for stocks, Bonnie.
All right, Abigail Doolittle, thank you for that update. It is time now for your latest Bloomberg Business Flash. Look at some of the biggest business stories in the news right now. Starbucks is planning to gradually expand operations at some stores in the United States. The coffee shop chain cited progress in the fight to contain the coronavirus pandemic. Starbucks says store activities will be limited to services like drive-through, delivery and takeout. Amazon CEO Jeff Bezos wants to test all employees for the coronavirus. That includes those with no symptoms. Bezos spelled out the steps Amazon is taking in his annual letter to shareholders. He says the company already has a team of scientists, managers and software engineers, and they hope to build a testing lab soon. Speaking of labs, Abbott Laboratories has suspended its guidance because of uncertainty caused by the coronavirus. In the latest quarter, sales were weakest at the company's diagnostics unit. That, of course, is likely to change. Abbott is introducing 3 coronavirus tests. One will tell if you've recovered from the disease. And that is your latest Bloomberg Business Flash. Guy.
Let's take a look at what's happening with the markets here in Europe. We are off our lows, but we're off our highs as well. Equity markets in Europe gapping higher first thing this morning. Dismal day yesterday. I think that needs to be borne in mind. So we did move a little higher this morning, but I think it's just sort of worth bearing in mind the very tight trading ranges that we're operating in now. Volatility, implied volatility, realized volatility really coming down relatively sharply over the last few days. And we are seeing tighter and tighter ranges, which is in some ways good and some ways bad. If you're a trader over at Morgan Stanley, it's going to make life a little bit more complicated. The big swings obviously have helped some of the banks out. How sustainable is that story going forward? In terms of where we are seeing the sector story today here in Europe, we've got technology, healthcare, food and beverage, the car sector actually rising, but utilities also up. So a more defensive bias when it comes to the stock story from a sector point of view. Oil and gas is trading down by nearly 2% today. We're also seeing the banking sector more broadly a little weaker as well. Up next, the Airbus CEO. This is Bloomberg.
was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We're 30 seconds away from the end of trading here in Europe for European equities. Let me just quickly show you what the session has looked like from a Stock 600 point of view. A gap higher first thing this morning, followed by actually a very, very tight range. We're off our earlier lows, and actually, to be honest, we're trading mid-range. We're up around 0.8 of 1%. One stock that is under a little bit of pressure today is Airbus. The Airbus stock down around 2%, circa 2% on the session today. As you can see, we're trading down by just over 2%, trading at 53.55. Let's focus on that business now in a little bit more detail. The global aerospace sector is facing its greatest challenge ever due to the coronavirus pandemic. That is according to the Airbus CEO, Guillaume Faury, who leads the world's biggest aircraft manufacturer. He said that a little bit earlier in a video message he delivered to the company's AGM. He joins us now exclusively from Toulouse in France. Guillaume Faury, thank you very much indeed. A stark warning about the state of play within the aerospace sector from you in that message. A tough message to deliver. Look, how is your business coping with the stress that it's under at the moment? How are your people doing?
Well, we have to face a very unprecedented situation, and we're facing that reality now. The situation of the airlines, our customers, is a very difficult one. Most of them have their planes to a large extent on the ground. That's unprecedented to have this at a global scale, and therefore we have to adapt. We have challenges as well on the supply chain, so we are recombining all our data points to basically move forward. And what we've done last week was to define a new production rate, a new production planning by plane, to be able to give the right direction to our partners, to our suppliers, and adapt to the change in the demand. Our customers are in a new situation. We have to adapt to that new situation too.
What are you hearing from your customers? So United over in the United States a little bit earlier on, saying that demand for travel is essentially zero. What are you hearing from other carriers?
Well, there's a very large diversity of situation around the world. The situation is not the same country by country, region by region, and also airline by airline. So what we're doing actually is to speak very proactively to our customers individually to find solutions one by one to their concerns. And actually, the situation is today what it is. You mentioned the situation of United. We have a similar situation with other airlines, but it's a very complex situation. It's a lot of work for all of us to adapt and find the right way forward. There's still a lot of uncertainty on when airlines will be back to service, when we will be back to normal, and what will be the shape of the recovery. So that's what we're working on at the moment.
What do you think of the state aid that has been given to certain carriers, Guillaume?
Well, we think, and I think the priority is on rescuing the airlines. They are the first hit by this pandemic. Obviously, no passengers, as you said, or very little passengers flying. And the priority, in my perspective, is to support the airlines going through this very difficult situation. And supporting the airline is also the best way to support the whole supply chain. So we're looking very much at our customers, the airlines, but as well the rest of the supply chain, to keep it alive in a very unprecedented period of challenges, so we can keep moving forward and recovering when the times will be better.
It looks like Boeing, your competitor, is going to ask Washington at some point for some form of state aid. Do you have similar plans? Do you expect Airbus to have to ask the French government or European governments for assistance?
We're asking for support, as I said before, to the airlines, to the suppliers. We're asking for support in different forms, but not in capital from the government.
Okay. That's good to hear. Just in terms of how you see the story developing, how much visibility do you actually have at the moment? I would imagine very, very little. So Cowen, the investment bank, it was out with a report over the last couple of days saying that it sees aircraft deliveries down 40 to 50% over the next 4 to 5 years. Is that what the future looks like to you, or do you think that the shock is going to be shorter and sharper?
Well, I don't have a crystal ball, and we're all trying to assess, as I said, the depth and the duration of the crisis. We think there will be a large difference between the wide bodies and the narrow bodies, the single-aisle family. The latter will probably recover much faster. What we see for this year is probably something like minus 30, minus 40% in terms of aircraft delivery, at least at the 2 days understanding of the situation, but it's still very dynamic. We've seen the recovery in terms of passengers flying behind us into China already. So China is very interesting because it's a place where we can try to assess what will happen for the rest of the world. But I think the figure of 40 to 50% over the next 4 to 5 years, in my view, looks quite pessimistic.
Okay, that's good to hear. So at this point, you're not in a position where you need to make any big decisions on resizing the business. You're not at that point yet.
Actually, we've just resized the business. We reformed last week our supply chain and as well the markets, that we have reduced the production rates for the single aisle from 60, where we were just before the pandemic, down to 40. And it's a very significant resizing of our production activities and deliveries. This will be stable for 2 or 3 months, and depending on the evolution of the global situation, we might revise that production planning. So yes, indeed, we have already taken harsh decisions to adapt and to face the reality we're in now.
But I guess I probably didn't phrase the question correctly, Guillaume. I apologize. You're not in a position at this point where you think you may have to lay people off.
Well, we have used systems in place, first relying on using holidays and the counters, the hours available already. Then we'll go into other systems which are furlough in the UK or Kurzarbeit in Germany, or this kind of way of dealing with the situation. We're preparing for that. We are not yet there. And then we'll see. Before we go to more difficult decisions when it comes to employees, this is your question, we want to have a better assessment on how the situation might evolve in the next month, what 2021 will look like, so we can make a decision that relies on the good balance between the risk and the scenarios that are ahead of us.
If you were to find yourself in a position where you are ready to reopen or start to reopen facilities, what is your planning at the moment in terms of dealing with staff? What is your plan for testing? You have very large sites, they're enormous, but access to them is relatively limited through certain key points. What are your plans in place at the moment to deal with testing? What is government telling you? What are your plans?
Yeah. Well, actually, we have a large presence on site in Europe. The low point of attendance on site was 2 or 3 weeks ago, depending on the different countries, and we are recovering from this very low point of activity. So we have more and more people on site. We might go to testing as an experience in Airbus to start to learn how to deal with it, but we are following the recommendation of the governments and taking more proactive measures as well when it comes to protecting people. This has been the priority. As you know, we've been hit first in China, where we had to learn, adapt, and a lot of measures have been put in place in China that prove that they're efficient, and that's what we're doing now in Europe. So we put priority on health and safety of people. We take them back to work progressively, but in Europe now we have recovered a level of activity which is significant.
Okay, so let's just dig into that a little bit more. For the 320 lines, you're going to be targeting around a run rate of around 40 under the new plan, as you say, as a result of resizing the business. When do you think that, are you able to achieve that now? When do you think you're going to be able to stabilize around that kind of number?
Well, we had a very significant production last week. We will have again production this week in our assembly lines in Europe. So China is working almost normally now, back on track. In Europe, we are at a reduced rate. It's difficult to judge on a weekly basis, but we think we'll be at this rate more or less for the month of April, May and June. So this is a rate of production. Now when it comes to deliveries, it's different. April is very difficult because of the bans and the restrictions on international travel, so it's very difficult for customers to come and take delivery. But actually, in terms of production rates, we will be able in Q2 to be at around 40. I cannot be very precise where we will be exactly. There's a lot of moving pieces, but we are around that level as we speak.
Do you think you are going to change the lineup of aircraft that you are going to build as a result of this? You cut back the 320 line, you cut back the 350 line, you've really cut back on the 330 line. Do you think that the 330 is still viable if you're only producing the number of aircraft that you're talking about at the moment?
Well, actually, we are reducing roughly by 1/3 for each one of our product lines. It's not unlikely that the wide bodies will be hit harder than the single aisle, so we will have to monitor that situation moving forward. We're keeping our products, and we think we have the right products, and even some of them will be the perfect ones for the post-coronavirus situation. So we keep our products. We think they are very good ones for today and for tomorrow, and especially the ones which have been improved, modernized recently, the Neo versions with very modern engines and very strong environmental performance will fit very well with the future. We think environment will be even more important moving out of coronavirus.
Is there anything that we can do, is there anything you can do, I guess not we, you, Airbus, to make aircraft sort of safer, feel safer as a result of the virus? A lot of people are going to be very nervous about getting back onto aeroplanes. Is there anything that can be done from a kind of engineering point of view? I don't know. Is it seat density? Is it air filters, which are pretty good anyway? What can be done on board airplanes? Maybe some of the surfaces that are on the aircraft as well, to make people feel a little bit more sort of comfortable getting on the planes, make them easier to clean, etc., etc.
Well, the industry is currently mobilized to find appropriate answers, solutions to these problems, the real problems and the perception as well. You remember after September 11, there was the threat of terrorism on board, and it was really something very difficult to manage at the beginning, and we found solution rather quickly, I have to say. And I'm optimistic that we'll find a similar solution, or different solutions to a different problem, but similarly. And with all the people and the engineers and the ideas which are coming on air on board, disinfection, but as well access to airport, access to plane, distanciation potentially on board as a first step before we move to other solutions. I'm very optimistic for all kinds of transport, by the way. We'll find solutions, including for aviation. We've done that before.
You certainly have. Guillaume, we really appreciate your time. Thank you very much indeed for spending some of it with us today here on Bloomberg Television. The Airbus CEO, Guillaume Faury, joining us from Toulouse. Funny.
Fantastic interview, Guy. Thank you for that. I do want to point out that we have the latest death toll now for New York. We have 577 people dying in hospitals in the last 24 hours and 29 people dying in nursing homes. Governor Andrew Cuomo saying the deaths are continuing at a tragic rate. It should be mentioned, though, that it's the first time that we have seen a number below 600 in some time. Staying with travel now, Bloomberg is learning more about cruise line company Carnival's handling of the coronavirus. More than 1,500 people from Carnival cruise ships have been diagnosed with COVID-19. At least 39 have died. Much focus was on the Grand Princess early in March. March 4th, passengers were told the CDC was investigating a small cluster of cases in California that may be linked to that ship. Passengers did see new hand sanitizer stations pop up and crew members beginning to wear gloves. But big gatherings continued that day. In fact, many went straight to the buffet when they heard. It wasn't until lunchtime the next day the ship's captain announced a quarantine on board. Carnival ships have become a floating testament to the viciousness of this virus. And they've also raised questions about potential corporate negligence and fleet safety. The CEO says Carnival's response to the crisis was reasonable under the circumstances. You can find out more. It's a great story, and it is the cover of the latest edition of Bloomberg Business Week. Let's check in now on the Bloomberg First Word News. Here's Ritika Gupta.
Thanks, Bonnie. The pandemic has started to take a bigger toll on the US housing market. New home construction fell last month by 22%. That's the most since 1984. The annualized rate is a little more than 1.2 million homes. Applications to build fell by almost 7%. They're a proxy for future construction.
Bit better, I can just tell you that the annualized rate, as Ritika was saying, was a little more than 1.2 million homes. Applications to build falling by almost 7% today. So a little bit of a mixed message there on housing. Let's take a look at where we stand markets-wise now. We have the Dow down about 0.3%, well off its low of the session. Remember, Boeing was the worst performer in the Dow. The S&P 500 is actually up 0.5% right now. And the Nasdaq is flying. It is up 1.7%. The Nasdaq really taking the lead today and running with it. Volatility still remains pretty elevated at 40, almost 41. In fact, the dollar index is back above 100 today. It's stronger by 0.2%. A weaker British pound at 124.24 and a weaker euro at 108.42. And I just want to point to crude oil as well, because here in the US we're at $20 on the nose. We're up 0.2% today, Guy.
Okay, Bonnie, let's take a quick look at where European markets have settled down on the day. What we saw was a very defensive story today in terms of the makeup and the nature of the market story. But the FTSE 100 up by around 0.5%. The DAX up by 0.2%. CAC 40 actually slipping into negative territory. Airbus, one of the factors behind that. Over in Spain, we saw Inditex very much under pressure as well. The oil and gas sector was the lead-lose sector. But from a session point of view, we did see initially a gap higher. We traded in a very, very tight range. We are expecting news at the top of the hour when it comes to the UK government's decision on extending the lockdown in Britain. We will bring that to you as part of the cable show. John Ferro will be over in New York. I'll be joining him here in London, and we'll bring you the daily briefing from 10 Downing Street. We'll be doing that on DAB Digital Radio in the London area and around the world on all of your Bloomberg devices. This is Bloomberg.
Live from New York, I'm Bonnie Quinn, along with Guy Johnson in London. This is the European Close on Bloomberg Markets. Time now for your latest Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. Hilton is raising cash by offering bonds and selling loyalty points. The hotel chain trying to ride out the crash in the travel market. Hilton says it's pre-sold, get this, $1 billion worth of points to American Express. The chain also plans to offer $500 million in senior unsecured notes. Volkswagen has abandoned its full-year forecast. The coronavirus pandemic has brought sales to a halt at the world's largest automaker. It's also forced VW to shut down factories around the world. Royal Dutch Shell is setting a bold target on cleaner energy. By 2050, the company plans to eliminate all net emissions from its own operations, and it wants to get rid of the bulk of greenhouse gases from fuel it sells to customers. Shell's move follows similar steps taken by PP and Repsol. And that is your latest Bloomberg Business Flash. Guy.
Thanks very much indeed. Bonnie, we're just getting some numbers coming through from LVMH, the giant luxury stock that will be seen as a benchmark for the rest of the sector. The luxury sector's done reasonably well, certainly on a relative basis. As a result, I think people are going to be paying a great deal of attention to what is happening here. The LVMH board is proposing a 30% reduction in the dividend, clearly an effort to preserve a little bit of cash. But the revenue number came in at 10.6 billion. That's down 17% on an organic basis. I'm just trying to look at some of the estimates. As far as I can tell, the revenue range was 10 billion to 11.2, so it looks a little at the bottom end of the range. It says the lockdown is going to hit revenues, fully revenues and earnings. I think that's pretty much unsurprising in the statement of the obvious. The fashion leather organic sales down 10%. It's going to further strengthen cost control. Again, an effort maybe to preserve some of the cash that it has right now. And we are going to continue to monitor some of the headlines that continue to come out. As I say, it looks like it's at the bottom end of the range. We'll see what the stock does first thing tomorrow morning. I'm Guy Johnson with Bonnie Quinn over in New York. This is the European Close on the Bloomberg Market. Time now for our stock of the hour.
Hey Guy, yeah, today our stock of the hour is ConocoPhillips. Shares are falling about 3% or so. Frankly, they have said that they have seen enough. They are America's #3 producer, and they've now decided to slash production by a quarter and cut capex, including suspending for all fracking in the lower 48 states. I want to flip up the board and take a look at output. The company said it was going to reduce 225,000 barrels a day. That's 100 million barrels a day in Canada and 125 million barrels a day in the U.S. So that is bringing net production down to the lowest that we have seen in years. What that means for the long-term stock price reaction is not good. We're still down now about 55% or so for the year. Reducing capex, they've said, by another $1.6 billion to $4.3 billion. Not enough, really, to help boost the share price and conserve cash. It does represent a total reduction of about $2.3 billion, or 35% of that initial capex guidance that they were given. What you can see on this board is where our energy comes from in the U.S. We know the story. Texas, offshore drilling, and then North Dakota and New Mexico. You're also folding over this into the world of the international markets. Prices are also not being held, frankly, by OPEC, coming out this morning and saying that they really just see under 20 million barrels a day needing to be produced in the second quarter. Flipping up the board again, we do know sort of the broader story here about our wells being drilled but uncompleted here. We do know that that number has slowed in the recent months. But another big story here is drilling wells but not completing them, in part because what do you do with all that oil once you take it out? We know, though, that the storage tanks are being filled up, so really hard to see a lot of this story continuing without more cuts, given the big drop in demand that we've seen. Guys, Bonnie?
Taylor, yes indeed. Thank you for that. That's Taylor Riggs there with our stock of the hour. Coming up in the United States, Balance of Power with David Weston. That's going to be on Bloomberg Television and on Bloomberg Radio. Now today, David is going to speak exclusively with Dallas Fed President Robert Kaplan. Definitely don't want to miss that after the type of economic data that we've been seeing in recent days. All right, let's take a quick look at U.S. markets now. We still have the Nasdaq running away with things. It's up almost 2% now. The S&P 500 is also making new gains. It's up 0.8%. And I just want to point to the Dow because it is now in the green. It had spent most of the day in the red. The industrials are what's powering the Nasdaq higher. This is Bloomberg.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
From New York to our TV and radio audiences worldwide, this is Balance of Power, where the world of politics meets the world of business. I'm David Weston, and welcome.
The CEO of Arias Asset Management, and Liz Young, BNY Mellon Director of Market Strategy. We do want to begin with stock. We have been all around a little bit, but we are now green across the board. The Dow is toeing that line, but you know the point I'm trying to make. So Liz Young, what is this action telling us about where you think we are and where you think we might be going on a day? We got another Tom Lee note who said not only is the bottom in, we're in a bull market recovery, reflecting what he told us on this very program the other day.
So I like Tom, and I respect his research. I don't disagree that the bottom is in and could be in, but it doesn't mean we're not going to see it again. And I think that this rally is pretty fragile at this point. There hasn't really been a good reason to rally up to this level, and I don't think that it's unreasonable to think that we're going to see another 10 to 15% pullback before we really get a decisive and durable move upward. There are way too many question marks, and the list of things that could surprise the market to the downside is much longer than the list of things that could surprise us to the upside here.
So, Joe Terranova, I want you to comment on something that Dan Nathan tweeted not all that long ago that I thought is an interesting way to look at the market. It's this bifurcation where you have the so-called MAGA stocks, the Microsoft, the Amazon, the Google, and Apple, which are going one way up, and then you have the bank stocks, which are going one way down, and it plays into this conversation about what are we watching here? Are we watching a stock market that is completely disconnected from Main Street, where Wall Street represents the Microsofts and the MAGA trade, and Main Street represents the banks, and the banks are the more telling of the two, and the thing you need to watch out for more than you need to cheer the upside in those tech names? What do you think?
I think it's absolutely fantastic, and that's exactly what you and I have been talking about over the last couple of weeks. The world is obviously going to change behaviorally for all of us as consumers. Well, maybe the investment world is changing, Scott, and maybe we talk about the Dow and we talk about the S&P, and we probably should not have that much relevance to it anymore. Maybe it is just about the NASDAQ and exactly what we see going on. Has the market bottomed? Absolutely, it's bottomed in the NASDAQ. That's evident when you see V recoveries from multiple stocks trading at their all-time highs. Now, I will caution, you are correct. Financials, energy, industrials cannot continue to lag as they are, and for us to have the expectation that the S&P overall is going to march above 2851, the high from Tuesday. You need their participation. At some point, you also have to give a fair understanding that it cannot be alone the Amazons, the Microsofts, and the Apples taking us higher. I would urge investors not to chase those names here. I think that's the wrong strategy. Be glad that you're long those names, but while you could have been chasing them in the weeks prior, I don't think that's the prudent strategy.
Which, Kerry, is the thing to hang on to more? Does the move in these big mega cap tech names represent the strength in the market and where we may go from here? Or do the banks and the big sell-off we continue to see there reflect the true underlying weakness in this market? And that's going to drive us. And you can, whoever has their volume up on their TV, please turn it down.
So, Scott, I think you're asking a good question. And what we've seen from the beginning of this bull market, you can look years back and say that the tech names, the digital platform, the communications companies drove the market higher. They outperformed on the way up. They outperformed on the way down. And in this recovery, the last 26% where the market has come back, they have also led. So I think that it's really playing against the odds to suggest that they won't continue to lead. What you're asking, however, is can the market go higher without participation from other sectors?
Well, not necessarily. I'm not necessarily asking that. I'm simply saying, Kerry, when you look at the market today, you can either hang your hat on this move in those tech stocks, or you can say, we may go back and test the bottom, or we could give up another 10 or 15 or 20% because the banks are telling you more to the downside than the tech stocks are telling you possible move to the upside.
Okay, so I believe that we're seeing this limbo phase. We're at around 2,800, right, up from 2,250 more or less. So we've made up more than half of the shortfall, that 33% the market fell. And the digital and tech stocks are telling you more right now about the market and expectations than the banks are. Part of the bank's problem, I mean, I think the biggest part of the bank's problem, it's interest rates. That was the problem before, and it's the problem now. You know, the whole economy has problems, as do tech companies. But if we go through this limbo, and even if the market treads water, what we need is to find out better sort of clarity on how we reopen, whether it's around testing, clinical trials, whether the Treasury program is working, what's happening in other countries like Denmark and Austria, where they are opening for business. They're opening their schools, and we've got to watch that. The market is watching that, but the market is very encouraged by what it's seen so far with intervention fiscally and monetarily. And we know there's bad news about unemployment. The market took that pretty well today. If the news means that we can open the country, I think that's positive. And if we can't open for a couple of months, I just think it's harder for us to trade higher. But I wouldn't dismiss what we've seen and the actions that the Treasury and the Fed have taken and what the market is believing the benefits of social distancing so far and compliance has been.
Yeah, speaking of social distancing and stay at home, as we get into more of a narrative about what the reopen is going to look like in various parts of the country, I should let you all know, and you know that we track what Governor Cuomo in New York State has said about the numbers in the last half an hour or so. He does say that the stay-at-home business closure orders will be extended now by 2 more weeks to May 15th, and I wonder, you know, as we came on the air, you had certainly a better looking market picture than you do at this very moment. I wonder if we've just given a little bit back on that news. It's hard to know, and things have been a little bit volatile, even on each side of the flat line, if you will, in the Dow. But it's something to keep an eye on as we talk about this move to get back to business as normal. I also wonder, John Najarian, whether the bond market screaming at the bulls in the stock market that you guys are way ahead of yourselves. And it's sort of what Lee Cooperman told us the other day, that the bond yields are telling you that there's severe economic stress. It's not just all of the stimulus that policymakers and the Fed and otherwise have done, that it is a true sign that there is weakness all throughout the economy, and the bond yields should be paid more attention to than perhaps where the stock market is in the next days and weeks ahead.
And maybe that's true, Scott. You know, the economy versus Wall Street. When we're seeing this right now, Scott, we're seeing the banks have basically had to carry an additional load, because not only are they the conduit for a lot of these loans that go out, but they're not getting paid on a lot of loans when people are basically forbearance. They're stepping back and saying, I can't right now, and we understand why, but that's why that sector is just so weak right now. And yet you look at a lot of the stocks that you named, FANG,